Interest rates hold the power to control inflation, but at what cost? Imagine walking into a store one day and seeing that your favorite snack, which used to cost $2, is now $2.50. A few months later, it jumps to $3. You didn't buy a better version of the snack, and the packaging hasn't changed. Yet the price keeps climbing. This slow but steady increase in prices over time is called inflation, and it affects everything from groceries and gas to rent and tuition. But what exactly causes inflation, and why does it seem to make life more expensive every year? Inflation is the decline of purchasing power. This means that as inflation rises, the same amount of money buys fewer goods and services. It's not that things are becoming more valuable, but rather that money itself is losing value. But why does this happen? There are a few key reasons. One major cause of inflation is demand pull inflation. This occurs when there's a strong demand for goods and services, but not enough supply to meet it. When consumers have more money to spend, maybe due to higher wages, government stimulus payments, or easy access to credit, they start buying more. This increase in demand puts pressure on businesses to produce more goods. However, if businesses can't keep up because of supply chain issues, labor shortages, or limited resources, prices naturally go up. A classic example of demand pull inflation occurred in 2020 and 2021. After governments around the world pumped trillions of dollars into their economies to help people during the COVID-19 pandemic, many consumers found themselves with extra money. With fewer entertainment options available due to lockdowns, people started spending on products like electronics, furniture, and cars. But supply chains were disrupted, and companies couldn't produce or transport goods fast enough to meet demand. As a result, prices shot up. Another example can be seen in the housing market. When interest rates are low, borrowing money becomes cheaper. This encourages more people to buy homes. But if there aren't enough houses on the market, competition drives up prices. This is why home prices surged in many parts of the world in recent years. Inflation can also be driven by rising production costs. This is called cost-push inflation. When the cost of raw materials, wages, or energy increases, businesses have no choice but to raise prices to maintain profits. If companies are paying more for fuel, electricity, or transportation, those costs get passed down to consumers. A clear example of cost-push inflation happens whenever oil prices rise. Since oil is a key ingredient in producing gasoline, plastic, and even certain food products, an increase in oil prices makes everything from shipping to packaging more expensive. When fuel prices spiked in 2022 due to geopolitical tensions and supply disruptions, consumers felt the impact everywhere. Wages also play a major role. If workers demand higher salaries due to the rising cost of living, businesses must either absorb those costs, reducing their profits, or pass them on to customers by raising prices. This is called the wage price spiral, a cycle where higher wages lead to higher prices, which in turn lead to demands for even higher wages. Another major driver of inflation is the money supply. If a country's central bank, like the Federal Reserve in the US, prints too much money or keeps interest rates too low for too long, it floods the economy with cash. While this might sound good, after all, who doesn't want more money? But it actually reduces the value of each individual dollar. Think of it like this. Imagine a rare collector's item, like a limited edition sneaker. If there are only 100 pairs in the world, people will pay a fortune to own one. But if the company suddenly releases 1 million more pairs, the value of each shoe drops significantly. The same logic applies to money. If there's too much of it in circulation, each dollar becomes less valuable, leading to higher prices for everything. A famous example is Zimbabwe in the late 2000s, where the government printed so much money that inflation reached 89.7 sextillion% per month, so high that people needed wheelbarrows full of cash just to buy bread. Inflation doesn't just impact numbers on a chart, it affects real people in meaningful ways. As inflation rises, wages often don't keep up. If someone earns $50,000 per year and inflation is at 5%, their salary is effectively worth only $47th of $500 in terms of what they can buy. This is why people feel like their money doesn't go as far, even if they're making the same or more than before. If you have $10,000 in a savings account earning 1% interest, but inflation is at 6%, your money is actually losing value over time. This discourages saving and pushes people toward investing in stocks, real estate, or other assets that may keep up with inflation. Retirees and others who rely on fixed incomes suffer the most during high inflation. If they're living on pensions or Social Security payments that don't increase at the same rate as inflation, their ability to afford necessities diminishes over time. Inflation impacts loans and mortgages too. If inflation is high, lenders demand higher interest rates to compensate for the declining value of money over time. This makes buying a home, financing a car, or taking out a business loan more expensive. Inflation isn't always bad. In fact, a small amount, around 2% per year, is considered healthy for an economy. It encourages spending and investment, since people know their money will be worth slightly less in the future. However, when inflation rises too fast, it creates instability, erodes savings, and makes life harder for ordinary people. That's why central banks like the Federal Reserve in the US or the European Central Bank in Europe step in to regulate inflation. Their primary tool? Interest rates. By raising or lowering interest rates, they can influence how much money circulates in the economy, either slowing down inflation or stimulating growth when needed. Know someone who needs to hear this? Share this video and help spread financial awareness. What are your thoughts on rising interest rates? Drop a comment below. We love to hear from you. Money moves the world, but it doesn't do so randomly. There's a system that controls how easily people can borrow, spend, and save. At the heart of this system is interest rates, one of the most powerful tools used by governments and central banks to keep economies stable. Interest rates determine the cost of borrowing money, the reward for saving it, and the pace at which cash flows through an economy. They affect businesses, consumers, and even entire countries. But what exactly are interest rates, and how do they influence inflation? Interest rates don't just set the price of loans, they control how much money moves through the economy, influencing the cost of living, job creation, and financial markets. Interest rates are the percentage of a loan that a borrower must pay back in addition to the original amount borrowed. They exist for everything from mortgages and student loans to credit cards and business investments. If you borrow $1,000 at a 5% interest rate, you'll owe $1,050 after a year. Banks don't just set interest rates randomly. The rates they offer customers, whether for savings accounts or home loans, are influenced by a much bigger force: the central bank. In the US, this is the Federal Reserve, often called the Fed. In Europe, it's the European Central Bank, ECB, and in the UK, it's the Bank of England. These institutions have a single powerful tool: the ability to set the benchmark interest rate, which affects every other interest rate in the country. When central banks raise interest rates, borrowing becomes more expensive, slowing down spending and inflation. When they lower rates, borrowing becomes cheaper, encouraging businesses and individuals to take out loans, invest, and spend more. Inflation happens when prices rise over time. One of the main ways governments control inflation is through interest rates. But how does this work? When inflation is high, people are spending too much, businesses are borrowing excessively, and the economy is overheating. The central bank steps in and raises interest rates to make borrowing more expensive. As a result, people take out fewer loans because they have to pay back more money over time. Credit card debt becomes costlier, discouraging unnecessary spending. Businesses slow down expansion plans since they don't want to borrow at high interest. The housing market cools off because mortgages become more expensive. All these factors reduce the amount of money circulating in the economy. With less money chasing goods and services, demand falls and price increases slow down, bringing inflation under control. On the other hand, when inflation is too low, which can also be a problem, central banks lower interest rates to encourage borrowing and spending. This helps boost the economy when it's struggling, preventing recessions and job losses. The impact of interest rates isn't just something economists talk about. It affects people's daily lives in ways they may not even realize. The most obvious example is loans. Most people don't buy homes outright. Instead, they take out a mortgage, which is a long-term loan. If interest rates are low, a mortgage is more affordable, encouraging more people to buy homes. But when interest rates are high, monthly payments rise, discouraging homebuyers and slowing down the real estate market. When interest rates rise, credit card interest also increases. This means that if someone carries a balance on their credit card, they'll have to pay more in interest each month, reducing their ability to spend elsewhere. Higher interest rates make financing a car or paying for college more expensive, forcing people to reconsider big purchases or delay education plans. While high interest rates make borrowing expensive, they also reward savers. Banks increase interest rates on savings accounts, meaning that money in the bank grows faster. Investors, however, might see stock prices drop as companies struggle with higher borrowing costs. Businesses rely on loans to expand, invest in new equipment, or hire more employees. When interest rates are low, borrowing is cheap, and companies can grow quickly, leading to more job opportunities. This is why periods of low interest rates often coincide with strong economic growth. However, when interest rates are high, companies think twice before borrowing. Expansion plans get put on hold, hiring slows down, and in extreme cases, layoffs happen. Higher interest rates can even cause recessions, periods of economic decline where businesses shrink, unemployment rises, and wages stagnate. One of the biggest challenges for governments is balancing interest rates in a way that controls inflation without slowing down job creation too much. This balancing act is at the heart of economic policy. Another area deeply affected by interest rates is the stock market. When borrowing money is cheap, businesses invest in growth and investors feel confident, driving stock prices up. But when interest rates rise, companies have to spend more on loan repayments, cutting into profits. Investors, seeing this, often pull their money out of stocks and move it into safer investments like bonds, causing stock prices to drop. This is why when central banks announce an interest rate hike, the stock market often reacts immediately. A high-rate environment tends to benefit certain industries while hurting industries that rely on borrowing, such as tech and real estate. Interest rates don't just affect one country, they have a global ripple effect. Since the US dollar is the world's most widely used currency, changes in US interest rates can impact economies around the world. They affect emerging markets, foreign investment, global trade, etc. This is why international markets closely watch the Federal Reserve's decisions. A small change in US interest rates can shift economic conditions in dozens of countries. The goal of central banks is to find the right interest rate, one that keeps inflation under control without hurting economic growth. For example, in the 1980s, the US faced extreme inflation, reaching nearly 15%. To fix this, the Federal Reserve raised interest rates to over 20%, a drastic move that slowed inflation but also triggered a severe recession. On the other hand, keeping rates too low for too long, as seen in the 2010s, contributed to soaring housing prices and high levels of corporate debt. Inflation doesn't just happen overnight. It builds up over time, fueled by excessive spending, supply shortages, and even government policies. When inflation gets out of control, it becomes a major economic problem, eroding purchasing power, making everyday essentials more expensive, and creating uncertainty in financial markets. That's why central banks step in, using their most effective tool, raising interest rates. But how exactly does this work? How does something as abstract as a percentage increase in lending rates cool down rising prices? The process isn't immediate, and its effects ripple through different parts of the economy. At its core, raising interest rates makes borrowing more expensive. When the Federal Reserve, or any central bank, increases its benchmark rate, commercial banks adjust their lending rates accordingly. This means that any individual or business that takes out a loan will have to pay more interest over time. Consider a simple example. Imagine you want to buy a car and take out a loan for $20,000. If the interest rate is 3%, your monthly payment might be around $360. But if the rate jumps to 7%, that monthly payment could rise to $400 or more. The extra cost might make you think twice about buying the car, or at least delay the purchase. Now imagine this happening across millions of consumers and businesses. This creates a cooling effect on the economy. With fewer people and businesses borrowing money, there is less spending overall. Since inflation is largely driven by high demand for goods and services, reducing spending helps slow it down. Inflation thrives when demand outpaces supply. When people are spending freely, companies can charge higher prices without worrying about losing customers. But when borrowing becomes expensive and people start saving more and spending less, businesses feel the pressure. With demand decreasing, companies can't keep raising prices like they did before. Instead, they may offer discounts to attract buyers. This is how higher interest rates directly contribute to reducing inflation. Businesses have no choice but to adjust their pricing strategies to match the slowing economy. One of the biggest drivers of inflation is rising wages. When companies make more money, they often increase salaries to attract and retain workers. While this sounds great for employees, it can also fuel inflation. When interest rates rise, companies begin to feel the effects. To maintain profits, many companies cut costs, often by slowing hiring, freezing wage increases, or even laying off workers. This has a domino effect on inflation. With fewer wage hikes and more uncertainty in the job market, people become cautious about spending. The result? Demand weakens further, leading to slower inflation. Interest rate hikes don't just influence loans, they shake up the entire financial system. One of the first places where the impact is felt is the stock market. When rates rise, companies have to pay more for borrowed money. Investors, seeing this, become cautious. They start pulling money out of stocks and shifting it into safer investments like government bonds, which become more attractive due to higher yields. This shift causes stock prices to drop, affecting both large investors and ordinary people with retirement accounts. Few industries feel the effects of rising interest rates as quickly as the housing market. Mortgage rates are directly tied to central bank rates. When interest rates rise, mortgages become more expensive, making it harder for buyers to afford homes. Fewer people apply for mortgages. Home sales drop. Housing prices stop rising or even fall. Since the real estate sector is a major part of the economy, a slowdown here has wide-reaching effects. Homebuyers spend less on renovations, furniture, and appliances. Construction slows down, impacting jobs in related industries. This contributes to a broader economic slowdown, which in turn reduces inflationary pressure. Another way interest rate hikes fight inflation is through their effect on currency value. When a country raises interest rates, its currency often becomes stronger relative to others. Investors from around the world are drawn to higher interest rates because they can earn better returns on their money. This increases demand for the country's currency, causing its value to rise. A stronger currency makes imports cheaper. One of the biggest misconceptions about interest rate hikes is that they work immediately. In reality, they take months, sometimes years, to fully impact inflation. This is because people and businesses don't change their behavior overnight. If a company already secured a low-interest loan before rates went up, they won't feel the effect right away. Many consumers are locked in fixed-rate mortgages, so they aren't affected until they need a new loan. Some businesses have pricing strategies set months in advance, delaying price adjustments. This is why central banks have to be careful. If they raise rates too aggressively, they might end up slowing the economy too much, leading to a recession instead of controlled inflation. The goal of raising interest rates isn't to make life harder for consumers and businesses, it's to restore stability. Interest rates are like the pulse of an economy. When they rise or fall, they send shockwaves through every corner of financial life. Businesses, consumers, and the entire lending system all feel the effects, but not in the same way. Some thrive while others struggle. Some industries adapt quickly, while others take months or even years to fully experience the shift. The way interest rates shape economic behavior is complex, but one thing is certain: no one escapes their influence. For companies, interest rate hikes bring a major challenge. Borrowing money becomes expensive. Not all businesses are affected equally. Large corporations often have enough cash reserves to operate without relying heavily on loans. They may also have access to lower interest rates because banks see them as safer borrowers. Small businesses, on the other hand, are hit the hardest. Many rely on credit lines or short-term loans just to manage daily operations. For startups, the challenge is even greater. Investors become more cautious during high-interest periods, making it harder for new businesses to secure funding. When the cost of borrowing is too high, many entrepreneurs put their dreams on hold. Higher interest rates don't just impact businesses, they change how everyday people spend money. When borrowing costs rise, consumers become more cautious, especially when it comes to major purchases. Beyond big purchases, consumers also cut back on credit card spending. Most credit cards have variable interest rates, meaning that when the central bank raises rates, credit card companies charge more for unpaid balances. People become more careful about swiping their cards, choosing to save money instead of accumulating debt. One group that benefits from higher interest rates: savers. When rates rise, banks offer better returns on savings accounts, certificates of deposit (CDs), and bonds. This encourages people to save more instead of spending. If someone has extra cash, they might choose to put it in a high-yield savings account instead of buying unnecessary items. This shift in behavior has a cooling effect on inflation. The more people save and the less they spend, the lower the demand for goods and services. Over time, this helps bring prices under control. However, the downside is that low-income families don't always benefit from higher savings rates. Many live paycheck to paycheck and don't have extra money to put aside. For them, the impact of higher borrowing costs outweighs the benefits of better savings returns. While interest rate hikes generally slow economic activity, some industries benefit from the change. Banks and financial institutions make more money from loans as interest rates rise. Investment firms see increased demand for bonds and savings accounts. Luxury brands may remain stable since their wealthy customers aren't as affected by borrowing costs. On the other hand, industries that rely on financing struggle the most. Real estate and construction see fewer projects and sales. Retailers selling expensive goods like cars, appliances, and furniture experience lower demand. Tech startups and companies dependent on venture capital face a tougher funding environment. Each industry adapts in its own way, but the overall pattern is clear. Spending slows, borrowing decreases, and businesses must adjust their strategies. Higher interest rates often lead to slower job growth. When businesses face higher costs and reduced demand, they hire fewer workers. Some might even lay off employees to cut expenses. This affects wage growth. When the labor market is strong, workers can demand higher salaries. But when companies tighten their budgets, wage increases become rarer. For employees, this means they may have to work longer at the same pay or even accept lower-paying jobs if layoffs occur. However, this labor market shift also contributes to lowering inflation. With fewer people earning big raises, overall spending declines, helping slow down price increases. The impact of interest rate hikes isn't black and white. Some benefit, while others struggle. Businesses must make tough decisions, consumers must adjust their spending, and banks have to navigate a changing lending environment. The economy is a delicate system. A slight adjustment in one area can trigger a chain reaction affecting businesses, consumers, and entire industries. Raising interest rates is meant to slow inflation, but what happens when the cure starts causing new problems? Let's explore the risks and limitations that come with this economic strategy. Inflation can be dangerous, but so can a sluggish economy. If interest rates rise too quickly, spending and investment can decline too sharply, leading to economic stagnation or even a recession. When interest rates go up, consumers cut back, businesses delay expansion, the real estate market slows. At first, these effects seem manageable, but if the economy slows down too much, businesses may struggle to stay open. Unemployment rises, wage growth slows, and economic activity declines. A central bank's challenge is finding the perfect balance, raising interest rates just enough to reduce inflation, but not so much that the economy collapses. However, predicting the right level is difficult, and even small mistakes can have major consequences. Consequences like unemployment increase, debt becomes harder to manage for governments and households. Stock markets and investments become more volatile. The real estate market suffers. Not everyone experiences interest rate hikes the same way. Wealthier individuals and corporations often have savings, assets, and investments that benefit from higher rates. But low-income households and small businesses are hit the hardest. People living paycheck to paycheck struggle with rising costs and expensive debt. Young workers may find it harder to get jobs as hiring slows. Renters face rising housing costs, making it even harder to save for homeownership. Meanwhile, banks and financial institutions profit from higher interest rates as they earn more from lending. This can create a widening gap between the wealthy and the working class, increasing economic inequality. If central banks push interest rates too high, they risk doing too much damage to the economy. This is called overcorrection, where attempts to slow inflation actually cause an economic crash. Spending drops too much. Businesses collapse due to high costs. Unemployment rises sharply. When this happens, the economy enters a recession, a period of declining growth, high unemployment, and financial hardship. Historically, aggressive interest rate hikes have led to recessions multiple times, including in the early 1980s, when the Federal Reserve raised rates to fight inflation. The result? A severe economic downturn that took years to recover from. Raising interest rates is one of the most effective ways to control inflation, but it comes at a cost. If not managed carefully, it can slow the economy too much and cause job losses, make debt harder to manage for families and governments, disrupt markets, housing, and investment, increase inequality, hitting low-income groups the hardest. The challenge for central banks is finding the right balance, cooling inflation without crushing growth. Too little action, and inflation spirals out of control. Too much, and the economy grinds to a halt. If you found this eye-opening, hit that like button. It helps more people understand what's really happening. Don't miss our deep dives into the world of money. Subscribe now and stay ahead of the financial game.